abilities.
Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great. It's interesting. We are in the heart of earnings season. We have the Fed on deck next week. Does anything else have your attention this week?
Well, it's hard not to think of the ongoing trade dispute with China still and what's going on. And then also some of the risk headlines coming out of Iran with the seizure of the tankers.
And it seems like the market's taking its stride, and by and large, we're seeing the S&P 500, at least the E-mini S&P 500, back above 3,000.
Yeah, so far so good. Earnings have been pretty decent at this point. So it's, just up and away, it seems like.
Understood. Well, let's get into this first lightning round. Are you ready?
All right.
Geopolitical tensions. Well, you hit the nail on the head earlier. It is interesting to see crude oil, WTI, the geopolitical tension. It's right there on the horizon, but doesn't seem to be front and center as the price of crude oil has drifted lower a little bit.
Well, it certainly seems like some of the supply output that's out there and some of the demand constraints have overtaken that geopolitical tension that you're talking about. However, that's not going away anytime soon.
No, I think you're right. And what is this recent price action? It seems like a little bit of a range bound. What is this recent price action opportunity-wise presenting?
Well, as we drift a little bit lower towards the bottom end of that range, I'm actually looking to possibly sell a put spread here to take advantage of a move back up either towards the middle part of that range or the upper part.
All right, so what exact trade example? Give me some strikes here. Give me some price levels here, Scotty.
Sure. So I'm looking at selling the week 1 54.51 put spread. That's the August 2nd expiration. So that's a couple bucks below the market right here. And this spread will allow an investor to collect about $340.
This makes a lot of sense. You want to respect the range. And remember, the September crude oil future contract was trading around 56.05 when this trade example was priced. And the at-the-money volatility was around 31. We talk a lot about the at-the-money volatility. Slightly elevated, but not outrageous, correct?
No, definitely not outrageous, but enough premium for an investor to collect that amount.
Great stuff, Scott. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
All right, let's do it.
S&P 500 3K. We talked about this 3,000 level, big level, some new all-time highs, kind of drifted lower last week, and all of a sudden we're reclaiming as the heart of the earnings season is really rolling out, but it seems to be the Fed. All eyeballs are continuing to be on the Fed next week, looking for that rate cut.
Absolutely, and the big question obviously is 25 or 50 and how the market is going to react to that.
Well, I'm in the camp of 25 basis points, but the trade example I want to utilize to embrace in the event we see the market kind of back and fill a little bit lower. I want to be a seller of a call spread. I want to be selling the week 2 30/30 3100 E-mini S&P 500 call spread. That's 1% out of the money here. That's the kind of premium we look to collect. Some people may go a little bit further, but 1% out of the money gives us a good opportunity here, as that 3,000 level is really imperative.
Yeah, and that would allow an investor to potentially collect around $562.50. And this expires, like you said, it's week 2, so on August 9th.
All right, and remember the SEP futures were trading around 29.95 and a half, and the at-the-money volatility was 11.
I like that a lot, Jeff, because again, premium levels not over the top, but enough there for an investor to really collect a nice amount.
And lastly, Scott, to your point earlier, is about trading a range. We've seen a little bit of a range bound since they made those new all-time highs. So as we see the market kind of consolidate here, selling a call spread will potentially allow you to embrace that range.
No doubt about it. And, with earnings right around the corner here, if we get a little pop to the upside, this could be a great way to take advantage of that.
Scott, thanks as always for coming on to Striking Options. Please tune in every week as we will continue to strike options.